Welcome. The purpose of this briefing is to address the single greatest structural risk to your capital right now. Our objective today is clear: to provide a systematic protocol for navigating this environment and, most importantly, for preserving your long-term purchasing power.
So here's how we're going to break this down. First, we'll identify the core problem. Then we'll look at the fundamental asymmetry between how you earn money and how wealth is actually built. After that, I'll walk you through a specific 5-fund protocol, show you what the data projects long-term, and we'll finish with what is arguably the most critical piece: the behavioral risks to execution.
Okay, let's dive right in. What is the foundational challenge we're trying to solve here? It's a structural flaw that impacts every single person earning a wage, and it has to do with the relationship between your income and the cost of simply living.
We call this wage-price divergence. And you need to understand, this isn't some temporary blip. It's a persistent structural headwind. It means the cost of things you need to buy is consistently running faster than your paychecks are growing. Over time, the value of your labor is being systematically eroded. It's like trying to run up a down escalator.
To make this tangible, let's look at the numbers. The data shows that a simple basket of groceries that cost you $20 just a few years back now requires over $25. Now, that's not just a statistic. That is a real, tangible loss of your purchasing power. It means any capital you simply hold in cash is actively losing value day by day. And this chart, well, it lays out the core problem perfectly. You can see the bar for wage growth right there, chugging along. But look at the bar next to it for peak inflation on essentials like food. That gap, the space between those two bars, that represents a guaranteed annual loss in real terms for anyone relying solely on a salary. So that leads us to the next critical point. Let's examine how this divergence creates a massive imbalance between just earning a living and actually building real wealth. Here's the crucial distinction you have to grasp. Your income from labor, it's linear. It goes up in small, predictable steps, like walking up a staircase. Capital assets, on the other hand, are capable of geometric or exponential growth. They compound. That's more like a rocket ship. Over time, the gap between that slow staircase and the rocket ship becomes mathematically insurmountable. This data point from our model really hammers the point home. The strategic imperative is clear. To counteract the guaranteed erosion of your wages, capital has to be moved from a savings environment where it's guaranteed to lose purchasing power to an equity environment designed to capture those geometric, market-driven returns. Okay, so if we know the problem, what's the solution? How do we actually do that? Well, let's examine the protocol itself. This is a specific 5-part framework designed for systematic, low-cost exposure to the market's growth engines. The architecture is actually very straightforward. It's a simple, equal-weight, 5-fund split. Each of these tickers you see represents a specific mutual fund, and each 20% allocation serves a very distinct strategic purpose. It's about creating balance. First up is the foundation of the entire portfolio, FZROX. Its only job is to give you exposure to the entire U.S. stock market. But here's the critical part. It does so with a 0% expense ratio. No management fees. This eliminates what we call fee drag, those tiny percentages that silently eat away at your returns over decades. The first step is to make sure all your capital is actually working for you. Next, we add an accelerator component, FSMDX. This fund targets mid-sized companies. Now, these aren't the giant corporations, and they aren't tiny startups either. Historically, they occupy a strategic sweet spot, offering higher growth potential than the giants, but with more stability than the really small guys. It's designed to add a bit of torque to the portfolio. Then, we need to look to the future with FITLX. This fund gives us thematic exposure. It focuses on companies with strong ESG metrics. That's environmental, social, and governance. Why? Because these are the firms that are well positioned for where capital and regulation are heading, making them structurally sound for the long term. Now for the defensive side, we bring in FDGFX. This acts as an income floor. It invests in stable, high-quality companies that have a long history of not just paying, but increasing their dividends. These are the kinds of companies that tend to hold up better when the market gets choppy, providing stability. And finally, we add FGRIX as our hybrid component. This fund blends both growth and income stocks. Its entire job is to smooth out the ride. Think of it as the portfolio's shock absorber, designed to reduce the severity of the ups and downs and make it psychologically easier to stay the course. So here's the whole architecture in a single view. You've got your foundation for core exposure, an accelerator for growth, a future-focused thematic piece, a defensive income floor, and a hybrid to smooth everything out. Each component has a job.
Okay, so that's the what. Now let's look at the why. What could this protocol actually look like over the long haul? This is an illustration based on historical market data to show the potential outcome of executing this with discipline.
Now, for this projection, we've kept the parameters deliberately conservative. A modest weekly contribution, a long time horizon, but the most critical parameter is the third one, an automated set-and-forget strategy. This is about removing emotion from the equation entirely.
This timeline is absolutely critical to understand. Look at the first 10 years. It's slow. We actually call this the valley of disappointment for a reason. It feels like nothing is happening. But then, you see that curve start to bend upwards? That's the acceleration phase. The real magic, the wealth event, happens in that final decade. Compounding is always backloaded.
And this right here, this might be the most important slide in the whole briefing. At the end of the 30 years, look at where the wealth came from. Less than 6% of that final value is the money you actually put in. Over 94% is the market's money, its growth. Your job isn't to create the wealth. Your job is to provide the seed capital and have the discipline to let the system do the heavy lifting for you.
This brings us to our final section. And frankly, this is where most strategies fail. The greatest risk to this entire protocol is not a market crash. It's your own behavior.
Adherence to these rules isn't a suggestion. It's non-negotiable. First, automation is mandatory. Take your emotions out of the driver's seat. Second, you have to understand this key idea. When you're in the accumulation phase, price drops are your friend. They allow your automated contributions to buy more shares at a discount. This isn't about timing the market. It's about consistency. And remembering that this entire strategy is a hedge against the guaranteed loss you face by holding cash.
So I'll leave you with this one question to consider. The true strength of any capital preservation plan isn't measured when things are going well. It's measured by its ability to survive your own emotional pressure when the market gets volatile. Is your strategy built for that? If you found this kind of data-driven institutional analysis valuable, make sure you subscribe to the Wall Street Trends channel. That concludes this briefing.